The tax benefits on pensions are immense. In fact, they are so good that the government has decided to put a cap on how much you can have in them. And if you go over this cap, you could end up with a 55% tax charge. Now, most people don't get anywhere near this level, but in April 2021, Rishi Sunak made a change that means that millions more people will be facing big tax charges on their pensions, unless they do something about it. Hello and welcome back to the channel. If you're new here, hi, my name is James, I'm a financial planner, and this is a place where you can learn to make smarter financial decisions. At the moment, if your pension grows above the lifetime allowance of £1,073,000, you could face a tax charge of up to 55%. Now, before you click off thinking, I'm never going to get to a million, clearly this video isn't for me, just hang on a minute, because number one, you might not be fully appreciating the power of compound growth. And number two, these changes that Rishi made last year in April are actually going to mean that many more people are going to fall foul of this. So in this video, I'm going to tell you everything that you need to know about the pension lifetime allowance and the strategies that you can put in place to prevent yourself being hit by this big tax charge. In April 2021, Rishi Sunak decided to freeze our personal tax thresholds for 5 years. This is known as a stealth tax because even though he did not technically increase the rate of tax, as inflation occurs over the years and as salaries rise, more people will be pushed into these higher tax bands. At the time, this didn't seem like a big deal because inflation was at 0.5%. But now, with inflation at 7%, everyone is going to start paying significantly more tax. And he did the same thing for the pension lifetime allowance, which was previously supposed to increase in line with inflation each year. But now, because he's frozen this and inflation has got so high, after 5 years, this allowance could be worth only £800,000 in real terms. Now, that may still sound like a lot, but just how likely are you then to hit this allowance? Well, if you've got £100,000 in your pension right now, and we assume you get a growth rate of 8% a year, it would take you 43 years. So that's 43 years without making any more contributions to your pensions. If you have 300k, it will take you 22 years. If you have 500k right now, it will take you just 13 years. And remember, that's without putting any more money into your pension. But let's say that you were contributing to your pension, and let's say you put in £5,000 a year. As you can see, that would bring things much sooner. Or what if you were adding £10,000 a year, or even £20,000 a year? As you can see, the lifetime allowance can actually be hit very quickly. So the question is, if you think you're going to go over this lifetime allowance, what can you do about it? Should you stop paying money into a pension? And if so, when? To answer these questions, we need to know two things. Firstly, why do people pay into pensions in the first place? And secondly, how does the lifetime allowance actually work? So, why do we use pensions? A pension is the most tax efficient vehicle you can use for building wealth. You get income tax relief on the money that you put into it. It then grows free of tax. When you retire, you can draw down 25% of the value as a tax-free lump sum. And although you might have to pay income tax on the rest of it, it's likely that you'll be paying a lower rate of tax than the relief that you got when you put money in. And since 2015, your pension now falls outside of your estate, so anyone can inherit it and there's no inheritance tax to pay. Because of this, if you are concerned about potentially having to pay inheritance tax, when you do get to retirement, it can often make sense to prioritize drawing down other assets that fall inside of your estate, like ISAs and property, before you draw on your pension. I cannot stress just how powerful this is. You can leave your pension silently growing in the background, and if you really do need it, for instance, to pay for long-term care, you can draw on it. But if you don't end up using it, when you die, you can leave it to your children and there will be no inheritance tax to pay. If you die before the age of 75, then they will actually inherit this as a tax-free cash lump sum. And if you die over 75, then they can inherit it as a pension, but they'll still need to pay income tax whenever they take money out of it. However, you could be even more tactical and instead leave your pensions to your grandchildren, who will probably not be earning any income at this point and therefore could draw the income out much more tax efficiently and pay for things like education. And these are the reasons why the role of pensions has shifted from one that is purely about creating an income for yourself to one that's actually about protecting and supporting your family, which means that they're sitting there growing for a lot longer, and there's now a lot higher chance that you're actually going to go over that lifetime allowance. Now, we also need to understand how the lifetime allowance, or LTA for short, actually works. If your pension grows above the LTA, you do not immediately face a tax charge. Instead, there are certain events that will trigger a test to see if a tax charge is due. There are quite a few of these events, but the main ones that you need to know about are: 1, when you take tax-free cash from your pension and place the remaining funds into a drawdown; number 2, when you turn 75; and number 3, when you start drawing a final salary pension. Now, the rest of this video is going to be focused on defined contribution pensions and how they interact with the LTA, but I'll leave a note down in the description of how this works with final salary pensions. So let's say you are 65 years old and you have a pension valued at £1.3 million. You've decided to retire and start drawing an income from your pension, and at the same time you want to take your full tax-free cash lump sum. Now, your tax-free cash lump sum is always limited to 25% of the LTA. So the maximum that you can take at the moment is 268k. Once you've done this, the rest of the pension is then designated into drawdown. This is also known as crystallizing a pension. When part of a pension is crystallized, it still remains invested in exactly the same way that it was before, but it just tells us that you've already taken the tax-free cash from this part of your pension. And if you want, you can start drawing an income from this drawdown pot. But of course, any income that you do take out, you may have to pay income tax on. You don't have to crystallize your pension and take all of the tax-free cash at exactly the same time. You can take small amounts out each year, and each time you do, you will use up more and more of your lifetime allowance. But in this example, to keep things simple, we're going to look at taking it all out at once. So we've taken £268,000 as a tax-free lump sum, which then leaves us with £800,000 left of our lifetime allowance that we've designated into drawdown. But what then happens with this excess over the LTA? Well, that depends on what we choose to do with it. If you take it as a cash lump sum, you'll be taxed 55%. Whereas if you designate the excess into drawdown, you'll only be taxed 25%. Being taxed 25% may sound better, but you need to remember that you'll still need to pay income tax when you actually take that out of the pension. And if you're a higher rate taxpayer and you're charged 40%, you'll end up with exactly the same amount in cash as if you'd taken it out via a lump sum and been charged 55% in tax. Most people decide to put the excess into drawdown because they are either a basic rate taxpayer or they want to keep more money inside the pension so it's safeguarded against inheritance tax. Now, when you turn 75, if you haven't done this already, this whole process happens automatically. You don't have to take anything out of your pension, and you can still choose to draw your tax-free cash whenever you want, but any excess over the LTA is tested and tax is charged. Most people look at this and think, okay, well, why don't I just crystallize my pensions earlier on, before they've got to the lifetime allowance, and then let the remainder keep on growing in the drawdown account? Well, firstly, by crystallizing this early, you are missing out on the maximum tax-free cash that you would have got if you'd let it grow all the way up to the LTA. And as the LTA is eventually expected to increase in line with inflation, you might have missed out on an overall higher LTA. And finally, let's say that you did this at age 65, and over the next 10 years, your drawdown pot continues to grow by £300,000. Well, at 75, any growth in the drawdown account is again tested against the LTA. In 10 years' time, the LTA would have increased to 1.25 million. But remember, you've already used up 80% of your allowance. So you've only got 20% of this higher LTA remaining, which would leave you with £250,000. So if you've seen growth of £300,000, 50k of this will still be over the allowance and tested again. But, and this is the thing, if during those 10 years you had drawn money out of your pension as income and kept the balance below the LTA, then no tax would be due. So for most people, this is what happens naturally. They retire and they take their tax-free cash and they start drawing an income from their pensions, which keeps the growth below the LTA. But if you don't actually need this income and you're just drawing it out to invest in something else so you can avoid this LTA charge, there's a few things that you need to be aware of. Firstly, it's likely that you're going to pay income tax on what you take out of your pension. And this could be 20%, it could even be 40%. A pension is also a tax-free growth environment that you will be forfeiting. Yes, you could put your money into an ISA, but you're limited by how much you can put in each year. And then if you don't actually ever end up spending that money, you might have to pay inheritance tax on it. And this is the really crucial part. If you don't think you'll actually ever spend the money yourself, then it often makes sense to just leave it in the pension. Yes, you'll have to pay the 25% tax charge, but if you die before the age of 75, your children can inherit this as a tax-free lump sum. And if you die after the age of 75, they will inherit the pension IHT-free, but pay income tax on whatever they withdraw from it. But again, you can be clever with this and leave this to your grandchildren. If you're already retired, there's not really much you can do about the lifetime allowance. If your pension keeps on growing, great. Yes, there may be some tax to pay, but you'd much rather have some tax to pay than no growth at all. But if you are still paying into your pension, you could choose to stop and instead invest in something else. So when does it make sense to do this? Well, again, it depends on a lot of things. Firstly, is your employer matching your pension contributions? If so, then it almost always makes sense to keep paying into your pension so that you can get that contribution match. Ultimately, this is a 100% uplift and it's free money. So even after a 25% tax, you're still going to end up ahead. Is your career on a trajectory where you're likely to earn more than £240,000 a year? When you earn over this amount, the amount that you can contribute into pensions starts to get tapered down from £40,000 a year to £4,000 a year. As such, it makes sense to keep paying into pensions whilst you still can. How much tax relief are you saving on your pension contributions, and what rate of tax do you think you'll pay in retirement? If you're getting 45% income tax relief on the money that you're putting into a pension, but you think that when you get to retirement you'll be a basic rate taxpayer, then even with the LTA charge and income tax of 20%, you'll still end up better off. Or if you earn between £100,000 and £125,000 a year, you could get 60% tax relief on your pension contributions by clawing back your personal income tax allowance, which means that even if you did end up being a higher rate taxpayer in retirement, it would still be worthwhile to pay into your pension. You also have to consider what other investment options are available. If you've already maxed out your ISAs, do you have alternatives that are going to be better than a pension? And finally, how far away are you from retirement or reaching the LTA? Although it may look like you might hit the LTA at some point in the future, we have no idea what's actually going to happen between now and then. Stock markets could end up having terrible returns. You could end up changing jobs and getting paid less, or having to stop work due to ill health. You could move abroad, or you could die. There are lots of reasons why you may never end up getting there, and given that your pension is the best tool that you have for building wealth, you need to make sure that you don't end up underutilizing it. So if you are far out, it probably does make sense to keep paying into your pension, and if you do end up going over the LTA, well, that's a nice problem to have. So by now you should have grasped the fundamentals of this problem, but I'm sure you've still got other questions. So please do take a look down in the comments, because somebody else has probably had the same question that you've got in your head right now, and you should hopefully find the answer. If you don't find that question, then please do ask me, because I want to turn this video and the comments section into the definitive place where you can learn everything that you need to know about the lifetime allowance. So despite the nuances of this, there are some clear takeaways. Firstly, you're much more likely to go over the lifetime allowance than you might think. You should keep paying into your pension until you're absolutely certain that you're going to go over it. Even if you're already over the lifetime allowance, there are reasons why you might want to continue paying into your pension. If you do end up going slightly over your lifetime allowance, then really don't fret about this. This is a good problem to have, and you'd rather go over it than under it. If you think inheritance tax is going to be an issue, then you're often better off leaving as much as you can inside your pensions and taking that 25% tax charge. And finally, taking money out of a pension to avoid an LTA charge will only ever make sense if you're actually going to spend the money at some point. And most of all, the lifetime allowance should not take away from the fact that pensions are still the best tool you have to build wealth, which is why your next step should be to watch this video here, where I show you how to sort out your workplace pensions once and for all and get them working hard for you. I'll see you there.